I'm watching something unfold in real time, and I need you to see it before the morning headlines bury it under the usual clutter. My name isn't important, but my access is. I've spent 12 years as a private commodities analyst, and I built this channel for one reason. I was tired of waiting half a day for Bloomberg to report what I had already seen on my terminal at 2 a.m. And frankly, I was tired of watching all these AI avatar channels pump out junk silver content with fake urgency and no data. So here we are. You're getting the raw feed unfiltered because if you're stacking physical or trading futures, you deserve to know what truly happened last night while you were asleep. Here's what I'm looking at right now. Silver spot price 87.59, down 5%, down 4.61 from where it closed yesterday. That's not the story. The story is how it arrived there. Around 10:40 last night, Eastern Time, someone dumped roughly 2,000 futures contracts into the COMEX order book during what traders call the empty hours. Low liquidity skeleton crew, the overnight bridge between New York close and London open. It's the window where a relatively small amount of selling pressure can create a disproportionately violent price move because there's nobody on the other side of the trade. And that's exactly what occurred. Silver got hammered from a 92 high down to 8759 in what can only be described as a vertical line on the chart. Now, if you're new to this, you might think, okay, so someone sold, markets fall. What's the big deal? Here's the big deal. And the fact that this condition is persisting, the fact that it's not reverting into contango, tells me that the shortage is not hypothetical. It's not some conspiracy theory. It's mathematically encoded into the price structure of the market. Now, let's discuss what this looks like from the perspective of the major players, the bullion banks, the market makers, the institutions that are short silver futures and need to either deliver metal or roll their positions forward. If you're short a March contract and the market is in backwardation, you have a problem because normally you could roll that short position into the next month, into April or May, and you'd actually collect a small credit because of contango. But now, rolling forward costs money because the curve is inverted. And if you try to deliver physical metal to meet the contract, well, good luck finding it at $87 when the Chinese are paying $100. So what do? You smash the paper price. You dump contracts into the overnight session when liquidity is low, and you drive the spot price down below 88, ideally below 85 to try to shake out weak hands, to trigger stop losses, to scare retail buyers away from taking delivery. And that's exactly what I think we saw last night. This wasn't profit taking. This wasn't technical selling. This was a coordinated effort to defend a price level. And I'm going to explain why I think that price level is so important in just a minute, because it relates entirely to options expiration this Friday. But first, you need to understand how backwardation functions as a trap for shorts. When the curve inverts, it's not just inconvenient, it's a signal that the paper market and the physical market have decoupled. Paper silver trades at 87. Physical silver, the kind you can actually hold, trades at 100 or more in Shanghai. The paper contracts are supposed to represent claims on physical metal, but if those claims can't be satisfied at the paper price, then what are you really holding? You're holding a promise worth less than the metal it's supposed to represent. And as more people realize that, as more buyers demand physical delivery, the pressure on the shorts becomes unbearable. They either have to provide the metal, which they don't have, or they must buy back their short positions at whatever price the market demands, which could be catastrophically higher than where they sold. This is what traders call a squeeze, and backwardation is the first symptom. It's the market signaling that the physical metal is being hoarded, supply is drying up, and shorts are running out of ways to meet obligations. So when I see a 30-cent backwardation in silver, I'm not thinking, oh, that's interesting. I'm thinking the trap is set. The question is how long it takes to spring. Now, let me show the math on the Shanghai arbitrage, because this is where the absurdity becomes undeniable. Let's say you're a big player. You have access to the COMEX, you have access to physical metal, you see silver trading at 87.59 in New York and 159 in Shanghai. That's a $13 spread. You buy 1,000 ounce bars in New York at 87. You ship them to Shanghai. If this were a broad-based de-risking event, if retail traders and institutions were all exiting at once, you'd see sustained heavy volume over a longer time frame. Instead, we saw a single spike, one dump, then it went quiet again. That's not market behavior. That's someone executing a precise trade with a precise objective. The objective was to move the price lower quickly before the East opened and had time to react. So no, I don't accept the healthy correction narrative. Timing is wrong, volume is wrong, fundamentals don't support it. Price action in Shanghai directly contradicts it. This was a targeted move, and the question now is whether it succeeds. Let me tell you what I'm watching going into Friday's close, because Friday is the line in the sand. Here's why. Options expiration. Every month, futures options expire. This month, there's enormous open interest in call options on both silver futures and the SLV ETF. Many of those calls cluster around $80 strike. If SLV closes above $80 on Friday, those calls go in the money. Market makers who sold those calls are short gamma, meaning they must hedge by buying the underlying asset, in this case, silver. And when they buy silver to hedge, it pushes the price higher, which makes more calls go in the money, requiring more hedging. It's a feedback loop. It caused the GameStop squeeze. It caused the volatility squeeze in 2021. And it could happen in silver if the price closes above that $80 level. So banks or whoever is short these options have every incentive to keep the price below 80 by Friday's close. That's why I believe we saw the dump last night. It wasn't about fundamentals. It wasn't about corrections. It was about pinning the price below a critical level to avoid a catastrophic gamma squeeze. Now the question, do they have enough firepower to keep it there for another day and a half? Here's what I'm watching. First, the $80 level on SLV. If we bounce and break above 80, if we close above 80 on Friday, I expect extreme volatility Monday. Hedging flows could be enormous, potentially sparking the dam to break. Second, I'm watching the Shanghai premium. If it widens from $13 to $15, Eastern buyers are getting even more aggressive. Western vaults more drained. At $15, arbitrage becomes so compelling, it overrides almost any logistical friction. Third, I'm watching the backwardation spread, currently 30. If it widens to 50 cents, if spot trades meaningfully above front-month futures, that's a sign the squeeze is accelerating. Market losing confidence in paper contracts to deliver metal. Let me tell my personal plan, because some hold physical, some trade futures, and want to know what I'm doing with my money. Not advice, just what I watch and my triggers. First trigger. If silver dips to $83, I add to physical holdings. 83 is key support, where we bounced a few days ago. If tested and held, bull market intact, noise only. Buying physical bars at that level, not paper or futures. If shortage is real, paper price increasingly irrelevant. Possession matters. Second trigger. If SLV closes above $80 Friday, I sit on hands over weekend, watch Monday. Gamma squeeze could cause massive gap up, not chasing. Waiting for momentum or one-day spike fade. Third trigger, backwardation hits 50. Ignore screen price entirely. Paper market fantasy. Real price is physical trading price, significantly higher than COMEX. Focus on vault data, delivery reports, headlines on force majeure or supply disruptions. Backwardation at 50 cents and widening, endgame. Let me also say what I'm not doing, not panic selling, not listening to headlines, calling bubble or speculative mania unwind. Been through enough cycles to tell real pullback from manufactured. This one smells manufactured, volume wrong, timing wrong. Fundamentals don't support it. Holding physical, watching levels, waiting for market to show hand. One more point. If banks so desperate, shortage real, why not let price run? Why fight? Answer, they're short. Contractually obligated to deliver metal or cover positions at a loss. Price run to 100, 120, 150. Losses catastrophic, billions. So they fight. Use every tool. Dump contracts in illiquid hours. Spread rumors. Push narrative of speculative frenzy collapse. Do whatever shakes out weak hands, buys time. But time runs out. Everyday Shanghai premium, $13. Everyday backwardation persists. More metal flows east. Vaults lighter, squeeze tighter. Eventually, no metal to deliver. Then, paper price, meaningless. Only price that matters. What someone pays for physical will be much higher than $87. Let me show institutional perspective. Say you're bullion bank, sold silver futures at $90, thought rally overdone, wanted premium. Plan, let contracts expire worthless if price fell, or roll forward if price stayed high. Now problem, price didn't fall, still high 80s. More importantly, curve and backwardation. To roll short forward, buy back near month contract at higher price than deferred month. Paying to roll, bleeding. Deliver metal. Buy $100 in Shanghai or scramble for Western inventory. May be unavailable. Either way, taking loss. What to do? Drive price lower, dump contracts during illiquid hours, create illusion of sell-off. Hope triggers stop losses, scares retail away. Hope price falls 85, 83, 80, short positions back in profit or reduce loss. Problem. Not working. Physical buyers ignore paper, paying $100 Shanghai. Backwardation persists. Every sale, every push down on paper makes accumulation cheaper for physical buyers. Feeding squeeze. Tightening noose around O neck. Math doesn't add up for banks. Lose-lose scenario. Price run, lose short positions. Suppress price, accelerate physical drain, eventual squeeze worse. Only way out. Demand collapses. Eastern buyers stop paying $100, except Western paper price. Not happening. Eastern buyers understand something West doesn't. Not about price, about possession. Securing hard asset before system breakdown. One more data point, inventory reports from ETFs and vaults. SLV ETF, largest silver-backed ETF, outflows past weeks. Not inflows. Investors pulling shares, converting to physical, taking delivery, adding pressure on vaults. Every converted share, ounce leaving vault. ETF sponsors say metal exists. Reports look fine. But metal encumbered, leased, hypothecated, promised multiple parties, actual available lower than headline. Shorts worry. Enough investors demand delivery, vaults run dry. Once empty, paper contracts worthless. IU is backed by nothing. Backwardation, critical signal. Market saying, don't trust future delivery, want metal now. Longer it persists, more confirms shortage real. Recap. Silver smashed 5% last night, over $90, down to 87.59ers. During a liquid overnight hours, low volume suggests coordinated move. Physical silver Shanghai over $100, $13 premium over Western paper. Gap should close via arbitrage, not happening, no Western supply. Silver futures in backwardation, spot 30 cents above March futures. Red flag, market desperate, doesn't trust future deliveries. Major options. Expiration Friday, calls clustered $80 SLV. Close above 80, gamma squeeze enormous. Verified measurable facts. What's going on beneath surface? Bullion banks short silver. Contractually obligated to deliver or cover, realize insufficient inventory. Fighting to keep price below $80. Avoid gamma squeeze, setting price high. Running out of time. Eastern buyers paying $100. Backwardation persists. Vaults draining. Paper selling overnight won't change that. Screen a distraction. Shows $87. Tells silver correcting. Physical market tells different story. Metal scarce. Possession king. Paper price increasingly disconnected from reality. Forecast 48 hours. Expect extreme volatility. Banks defend $80. More illiquid hour dumps. Physical buyers continue. Shanghai premium elevated or widening. Backwardation persists. Close above 80 Friday. Monday explosive. Close below 80. Squeeze delayed. Fundamentals unchanged. Shortage real. Vaults draining. Paper market living on borrowed time. Personal plan. $83 buy physical. $80 Friday. Close signals next steps. Backwardation. Ultimate truth teller. Hits 50. Ignore screen. Real price. Whatever people pay for metal in hand, much higher than paper market. Built channel, tired of waiting 12 hours for news to catch real-time terminal data. Tired of AI avatar channels pumping fake urgency, garbage data. Real feed here, primary data, terminal access, vault reports, honest assessment. Stacker, trader, over a decade watching games big players run. Watching game ending, rules breaking, arbitrage not closing, backwardation not reversing, physical market calling bluff, hold line, watch physical, ignore noise.